Our next guest says that risks around tariffs continue to cloud the outlook. Joining us is Bill Campbell, Global Bond Portfolio Manager at DoubleLine. You're the guy that does the macro, Bill. So can we just start on the dollar for a moment? How do you understand the dollar's price action? And is there going to be a real shift in how overseas investors look at that asset?
Well, thank you for having me. I think that yesterday's price action is something that really all investors should take note of. Over the past 2 decades, with low and negative interest rate policy across the globe, we saw trillions of dollars of foreign investment come into the United States. And really, with U.S. equity returns, private equity returns in the United States, you just had no other place for global investment really to find an area where they could have capital growth outside of the United States. And unfortunately, what we're seeing right now with the change in trade and tariff policy, as well as a change in geopolitical policy from the United States around the security guarantees, is maybe a rethink of, does that capital really need to sit in the United States? So I think what we saw yesterday, and potentially what we're likely to see over the medium term, is either a repatriation of that capital, of foreign investment flowing back out of the United States, or at least more dollar hedging and new capital maybe not flowing in. I think today's move is much more in line with the traditional dollar standard that we would have expected with a global economic shock. Today, we saw emerging markets hit the hardest, with China responding to, with retaliatory tariffs of their own. That obviously hits the global economic outlook, and capital is flowing, really to the safe haven asset of U.S. Treasuries in a knee-jerk reaction. Now, that's near term. Over the long term, I'm afraid the longer that these policies from the Trump administration remain in place that are aggressive, isolationist, the more that we're going to see foreign capital find other homes, the more we're going to see the potential for returns in international markets go up. And it puts the dollar at medium-term risk. And with this, one of the things this administration is trying to do is juice growth by bringing down the overall cost of capital in the United States. You've heard Scott Besson talk about that. And if we don't have foreign savings flowing into the U.S., that's going to make that, objective or that goal very difficult.
So, but I understand that a lot of these short-term moves, we can't read too much into how it plays out long-term. But you put some of these day-to-day moves together, and you do get a better sense of the trend. I'm not sure what the trend is with the dollar right now. A lot of people are betting on weakness. I see just as many people betting on further strength. Where does it go, Bill?
Well, I think you need to look at differentiation. So let's first break out the bucket that is working as expected. The currencies that are hanging in, with strength that we would expect in a period of economic uncertainty are the yen and Swiss franc. Mm-hmm. Those are, flight to safety currencies, and that makes sense to me. The one that is a little bit that may be bucking the trend this time around is the euro. Again, the euro's had a decade and a half of negative interest rate and low interest rate policy that has led to European capital flowing into the United States. And in a time of global economic uncertainty, there is the potential for that capital to be brought back home. In emerging markets, I think there's still a tie to China growth, and the economic uncertainty and volatility I would expect to manifest itself in weaker currencies, more like what we're seeing today. One other thing to just keep in mind, if the dollar continues to weaken with U.S. tariffs going higher, that actually increases their impact on their economic impact globally. The idea with a strong dollar and weakening currencies is that the currency weakness from an international perspective would offset some of the impact of that tariff. And if that doesn't happen, the feed through for growth economically has the potential to be even worse. Yeah. And the feed through to inflation domestically has the potential to be more persistent or longer lasting.
And this is always a good time to kind of remind folks, too, I mean, we're still kind of at the early stages of this. Obviously, we've gotten the U.S. side of the equation. But as you saw this morning, Bill, with the announcement by China, this is a market that's still on edge for what the retaliation is going to be from other countries. We haven't heard from Europe yet, because that could be a big one. It's not clear when that's going to happen. But I assume over the next few days we will. How will the market take that if they retaliate in a similar magnitude that we saw from China?
Oh, I am extremely worried. The reaction would be negative and more in line with the price action that we've seen today. If we get similar responses from Europe that we got out of China, basically matching the U.S. policy, that would be clearly growth negative going forward. Now, on the other hand, I think we also need to consider what's happening with the news around Vietnam.
Yeah.
If we can get quick agreements on a bilateral basis, or maybe on a multilateral basis, where we have trade barriers globally brought lower, then that changes the economic picture materially. But unfortunately, we're kind of playing against the clock on this one. So I would encourage the administration and all global leaders to try to reach a new equilibrium and hopefully reach a place where we can pull back all global trade barriers, all tariffs in the short run, because the longer this lasts, the more the negative impact is going to be on growth, the more we're going to have at risk the labor market, the more we're going to have at risk asset prices.
Yeah, I mean, that's probably definitely not going to happen, Bill, from what we've heard from the administration. Does this move the dollar out of a global payment system on the margin in a more meaningful way?
So we've been writing about this potential, for multiple years now. Ever since the sanctions on Russia took them out of the global payment system. I think that we started to see small movements in that direction. What we've also seen is a lot of movement towards regional trade agreements. You're seeing Asia is kind of really leading the way in developing, a strong network of regional trade and bilateral trade agreements and memorandums of understanding between their central banks to settle trade in their local currencies and basically removing the dollar from those settlements. I think the actions that we're seeing today are only going to increase that going forward. I do think that it will take time to play out, that we are talking about, a multi-year process. But the longer that this policy remains in place, the more at risk the dollar is of maybe not being replaced by a new single currency that's going to be the reserve currency and the standard for global trade and settlement, but a multipolar world where countries look at what is their balance of payments, or who do they trade with and who do they invest with, and then their FX reserves and the capital that their investors hold will much more closely reflect that rather than just a dollar-based investment portfolio.
So I have to ask you, Bill, I mean, the final question here, but kind of how does this market reset? I mean, it's obviously going to take some time if there is a deal for obviously these individual nations or maybe something a little bit more wholesale. But there's going to be probably a significant gap before we get there. What does repositioning look like for those folks that are either sitting on the sidelines or maybe potentially sitting on big losses right now?
Yeah, so I think ultimately we're going to see investors globally are going to hold a much larger piece of the of international fixed income and international equities in their portfolios. I think that the rewiring of global trade that's happening now is only going to continue and going to accelerate. We're going to see many countries using their fiscal space that they have available to them to try to build out their national security and defense efforts, which is kind of what we're seeing in Europe right now. That is going to increase the potential for earnings growth and then multiples growth in international stock markets.
Yeah.
So I think that ultimately this leads to into a place where international investors and U.S. investors are going to be looking at, a much broader composition of markets and currencies in their portfolio as compared to today, where the dollar and U.S. equities and U.S. investment, really has held a major spot in investors' portfolios.
All right, great stuff, Bill. Got to leave it there. Bill Campbell, Global Bond Portfolio Manager over at DoubleLine.